Hi folks, Chuck Gibson from Financial Perspectives with November 2017's Charts on the Move. As with last month, I want to make this video short as there's nothing that has really changed. I'm running out of different ways to say we're in a bull market. Putting that aside, hopefully by now the recent action illustrates what trending markets are all about and why it's important to follow the sage investment advice about the trend being your friend. This month I'm going to do a quick update on global stock markets, but I also want to show you two interesting dynamics that are going on underneath the US indexes. Let's get to it. Normally I like to use the S&P 500 as my proxy for when showing charts of the US stock market, but in my first chart I'll instead be using Vanguard's Total Stock Market Index, VTI. It's just the S&P 500 plus small cap stocks. It's a much better representation of the US stock market. As you can see in the first blue uptrend line and how price up here eventually began to run out of steam and then move sideways. As buyers dried up, it fell, attempted a feeble rally, and then fell some more, eventually making its first lower low. This is your typical ABC correction. A, B, C. At this point in time, investors could and should have started to get worried as a lower high and lower low had been formed. This, as we know, is one of the precursors to a trend reversal. But on its next rally higher, that fear was put aside as it went on to create a higher high here, invalidating the prior move and reaffirming the bull trend was still intact. Since then, we've had a very strong uptrend with no sign of the rally running out of gas. Turning to the chart of EFA, which is an aggregate look at the developed world stock markets, excluding Canada and the US. In the bottom pane is the performance of the EFA index as compared to US stocks. As you can see, the downtrend has, at least temporarily, halted and is now performing in tandem with US stocks. With some work, it looks as if it wants to start and assume a leadership position. In the upper pane, price is above its rising 200-day moving average, but sits just below major resistance as it is underneath 2014's prior high. A break and hold to the upside would be a very bullish sign for continued strength in global equities and maybe the impetus for the rest of the world stock markets to turn course and outperform their US brethren. My next chart, a view of the smaller emerging markets, show an almost identical copy of what's occurring in the prior EFA chart, except for the fact price has already broken out to the upside here and is currently in the process of backtesting that support level. Like EFA, if this breakout holds above support, it's another feather in the bull's cap and a sign for ongoing equity strength. On the other hand, a break back down below support sends an awfully bearish message and probably portends to a possible trend reversal or, as a minimum, a correction. I realize I probably sound like a broken record, but stocks, for now, as they have been since mid-2016, are the place to be. At some point this will change, but there's nothing as of yet telling us to be risk averse. Anyone telling you otherwise is likely trying to sell you something. November turned out to be a great example of market rotation. As bull markets age, you'll see money leave strong sectors for weaker ones. Prior beaten down stocks eventually have mean reversion rallies. As you get closer to the end of the run, there is little new money to purchase shares, so it causes money to leave other sectors, driving down prices in order to free up cash to pay for the new acquisitions. In this way, the indexes have the ability to grind higher without the need for a huge pile of new capital. My first chart helps illustrate rotation. Here are two charts that show the performance of the major US stock sectors. From left to right, the sectors are consumer cyclicals in dark blue, technology shares in light green, industrials in magenta, materials in light blue, and energy in black. Next up are consumer staples in dark green, healthcare in dark purple, followed by utilities in red and financials in maroon. The upper chart reflects performance of the month of October, while the bottom one is for November. What you can see is that money rotated into consumer cyclicals, industrials, healthcare, and financials. Shares of those sectors were bid up in price due to the flow of money out of mostly technology and materials, and to a lesser extent energy and utilities. Rotation becomes the lifeblood of bull markets as infusions of new investment capital dries up. Taking a look at the charts of a couple of big sector rotation winners, starting with industrials, we see price breaking higher out of a short consolidation with a very large candle, indicating the strength of the move. The banks in my next chart show a similarly large move, but from a much longer consolidation. And while I did not show transports as their own sector above, because most are categorized in the industrial sector, you can see that they had a monster final week to the month. On the flip side, looking at last month's biggest loser, technology, its pullback looks like a tiny blip, sort of like an ant on the back end of an elephant. Something to keep in mind is that while rotation is a normal occurrence, I find it almost impossible to profit from if you're a long-term investor. The second and final event I want to highlight that has been occurring more frequently as we become stretched to the upside is where good stocks are taken out to the woodshed and beaten with a stick if they miss the street's profit and revenue expectation while reporting quarterly financial data. You see, when you're in the early stages of a bull market, say, for example, in 2009, companies can report the loss of millions of dollars and their stock prices would climb on the news as long as they reported less bad financials. It's not only about the numbers, but very often more important about the expectation and how the market interprets that data. In early bull markets, bad is good and good is even better. This all changes though as we move higher and deeper into a bull market. Good can become bad and bad is awful to stock prices. I want to show you a few charts of stocks that have reported some okay to good 2017 numbers, but were not viewed well by the market and got pummeled as a result. The first chart is of Signet Jewelers. Their most recent announcement was actually not bad, but they got spanked hard as their stock prices fell 38% in less than 2 weeks post-announcement. My second chart is that of Under Armour. The company's not going away and is still very profitable. There's no doubt they have their challenges as consumer tastes are fickle and are seeing flattening sales and profit growth. Though the last 3 quarters earnings announcements, the stock has fallen more than 65% peak to trough. Anyone heard of TrueCar? They're a way to buy a car with no haggling and dealing with pushy dealerships over the internet. I've used them and love their service. As good as their service is, their last 2 quarterly reports have been less than stellar and their shares have dropped more than 50%. Anyone eating at Del Taco? Me neither, but their shares were beaten down more than 25% in a month and a half after their most recent earnings call. This company's a money-making machine, but the markets don't seem to care. Finally, my last example is of Trivago. In case you don't know, it's a travel website who competes against Priceline, Kayak, Orbitz, Expedia, and TripAdvisor, etc. Apparently, they need to shake things up a bit. Maybe go out and hire William Shatner as their spokesman. They need some real help saving the ship, as shares have dropped 70% over the past 2 quarters' earnings announcements. These are but a few of many I could show. The takeaway here is that with this as a backdrop, I find investing in individual stocks a lot less appetizing right now. With good earnings sometimes resulting in substantially lower stock prices, I'm becoming less willing to take on single stock risk and the possibility of underperformance. I find the current risk environment better handled by committing money across sectors in regional ETF baskets. That is, of course, until the next major correction occurs and brings us more compelling buying opportunities. As we wind down the year, I want to take this time to thank everyone for their continued support and trust and wish everyone a joyous holiday season. I expect 2018 will bring some very large changes to what would have been a rather benign bull market. I can't wait. Well, until next month, as always, appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with November 2017's Charts on the Move.